IRS Form 8862, information to claim certain credits after a disallowance. Basically, taxpayers would file IRS Form 8862 if they've previously attempted to claim a tax credit. It was denied for some reason other than a math or a clerical purpose, and the taxpayer believes that they meet all the requirements for that credit. So tax credits that you can apply for include the earned income credit, the child tax credit, or additional child tax credit or credit for other dependents, and then the American Opportunity Tax Credit. So those are the types of credits that you can use IRS Form 8862 to apply for. So there are a couple of situations in which you must actually file this, but basically they all come down to previously disallowed tax credits that you believe you meet the requirement for. So if you don't believe you meet the requirement, you don't need to claim, you don't need to file this form. And if you're claiming the earned income credit without a qualifying child, and the only reason it was reduced or disallowed in an earlier year was because it was determined that a child listed on your schedule EIC was not your qualifying child. You don't need to file this form. You can simply take the credit without filing the form if you meet the credit's eligibility requirements. There are a couple of situations when you don't file IRS Form 8862. So one would be 2 years for the next 2 years after the most recent tax year in which the IRS made a final determination that your credit claim was due to an intentional disregard of the rules or reckless disregard of the rules. Or 10 years after the most recent tax year in which there was an IRS final determination that you committed fraud to claim that credit. So if there is a reckless and intentional disregard, that's a 2-year, I guess, ban from using this form to try to claim that tax credit. If the IRS actually makes a determination that you fraudulently tried to claim a credit, then it's 10 years. So all tax filers will complete Part 1, and then we'll briefly walk through the form. So if you're claiming the earned income credit, you would complete Part 2. If you're claiming the child tax credit, the additional child tax credit, or the credit for other dependents, you would complete Part 3. And then if you're trying to get the American Opportunity Tax Credit, you would complete Part 4. So there's the earned income credit section, and this is, Section A is for filers with a qualifying child or children, and then Section B would be filers without. So in that situation, you're doing one or the other, presumably not both. In Part 3, you would be looking to claim the child tax credit, the additional child tax credit, or the credit for other dependents.
No one ran the district.
And then in Part 4, the American Opportunity Tax Credit. This is where you would claim the credit for up to 3 students that you believe that you've earned the credit for. And then Part 5, you would complete this only if there's a child that meets the conditions to be a qualifying child for you and for another person other than your spouse if you're filing a joint tax return. And if you have more than 4 qualifying children, then you would attach a statement. So let's go back to the top, and we'll just complete. We'll go through each of these sections separately. So our hero, John Doe, and his social security number. So everyone completes Part 1. You're going to complete Part 1 for the tax year that you're filing this form. So let's just say that we're doing this for 2022. And then you check the box that applies to the credit that you wish to claim. So in this first part, we'll go through the earned income credit. After we go through Part 2, then we'll come back and and revisit the child tax credit, and then we'll do the same for the American Opportunity Tax Credit. So, and you can check multiple boxes. So check the one or ones that apply. In the earned income credit, if number 3, if the only reason your EIC was reduced or disallowed was because you incorrectly reported your earnings, your earned income or investment income, you can check yes or no. If you check yes, do not complete the rest of part 2. Simply attach this form to your tax return to claim the EIC. So we'll say that that was not the only reason. In line 4, if could you be claimed as a qualifying child for another taxpayer for the year that you entered in line 1? So if you or your spouse answer yes to question 4, then you cannot claim the earned income credit. So we'll say no. Now, this is where you go to either section A or section B. If you have a qualifying child, go to section A. If you don't have a qualifying child, go to section B. It's pretty simple. So for the purpose of qualifying child or children, they must meet the following criteria. 1, the child is your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half brother, half sister, or a descendant of any of those. So it could be a grandchild, it could be a niece or a nephew. 2, the qualifying child was either under age 19 at the end of the year, so in this case 2022, and they're younger than you, or they were under 24 at the end of the year and they're a student and they're younger than you, or they're any age but they're permanently and totally disabled according to the IRS definition. 3, the qualifying child is not filing a joint tax return for the year, or is only filing a tax return to claim a refund of withheld income tax or estimated tax paid. And then final criteria, they have to have lived with you in the United States for more than half the year. So technically, only one household can claim the EIC, and it happens to, so even if there are 2 households where the qualifying child stays or receives support, that qualifying child has to have lived with the family for more than half a year. So by definition, only one family can claim that credit. So we'll answer, and we'll just say that their child, Susan Doe, meets the criteria. In line 6, does your schedule EIC show that you had a qualifying child? If you checked no, you don't need to complete part 2, section A. You would just go to section B, because then at that point you would be claiming the EIC for someone that's not a qualifying child, or under conditions where you don't have a qualifying child. So in line 7, so we'll check yes, and then we'll go through the rest of section A. In line 7, we'll just enter the number of days. So if you enter a number less than 183 or 184 in a leap year, then you cannot claim the EIC. So we'll say that it was 190 days. If the child was born or died during the year that you entered, so in 2022, you would enter the month and day that the child was born or died. Otherwise, you can just skip the line. So basically, section A, you're just verifying that you have a child, that you either did or did not complete schedule EIC, and if you did, then you have to put in the number of days that the child lived with you. And you also have to state whether or not that child was born during the year or died during the year. So obviously, we'll go through section B as if we didn't have a qualifying child. So let's go to section B, and you would enter the number of days that the main home that you lived in was in the United States. Again, being in the United States, physical presence as far as your primary residence has to be more than half the year. Now, if you're in the military stationed outside the United States, certain kind of, I guess, criteria don't apply. So if you're on extended active duty, which is active duty orders for either an indefinite period or for a period that's more than 90 days, then you are considered to be located in the United States for this purpose. So in line 9B, if you're married filing a joint tax return, then you would enter the number of days that your spouse's main home was in the United States. So again, if you're in the military, if you're stationed overseas on permanent change of station orders, you would be covered as if you lived in the United States. You can then still apply for the earned income credit. In line 10, you or your spouse, if you're filing a joint tax return, have to be at least age 25, but less than 65. So let's just say that you and your spouse are 30 years old. Now, if your spouse died during the year, or you're preparing a return for someone during the tax year, there are special instructions that you might have to meet. So the age test is met under one of those circumstances if the deceased taxpayer met the applicable minimum age at the time of death. So if that person was at least age 25, they can still meet the criteria. Now, you're considered to reach the minimum age on the day before your birthday. But if you reach 65, you're reaching 65 on your 65th birthday. So that means, not a lot really when it comes to the year that someone turns 65, unless they happen to turn age 65 on January 1st. In that case, they would still be able to claim the earned income credit for the year, the complete year before the age of 65, but not for the year that they actually turned. Conversely, someone that turns 25 on January 1st would be able to claim the earned income credit because they would be considered 25 on New Year's Eve, according to the IRS instructions for this guidance. And then they could claim that year early. Now, 11A and 11B asks if either you or your spouse can be claimed as a dependent on another taxpayer's return. Again, these are all criteria which, if you don't meet the criteria, like if you can be claimed, then you cannot claim the EIC, right? So this is the IRS just asking you to verify that what you're saying here is true. And the only reason you would be doing this is if you got a notification from the IRS saying that your credit was disallowed the first time you tried to give this information to the IRS. So most likely you're correcting a mistake, or you overlook something the first time around. So be very careful, because this is also an opportunity for someone to get caught claiming a credit falsely. And so just be sure that you're not doing that even by accident, because if any of this gets disproved again, then there are stiff penalties for in the future, right? So if it's a reckless disregard for the instructions, that's a 2-year ban from using this form. If it's actual fraud, it's 10 years. So just be mindful that, this form works for correcting mistakes, but the IRS is also very sensitive to people looking at this as an opportunity to kind of work around a system that maybe they shouldn't be working around. So let's flip over to the child tax credit section, which is in part 3. So again, we'll enter the name of Susan Doe. Now, this is the child for which you're claiming the child tax credit, the refundable child tax credit, the additional tax credit. If you have more than 4 qualifying children, then you would need to attach a separate statement and answer, put the information for question 12, and then lines 14 through 17 for those people. In line 13, you're doing the exact same thing, but you're doing it for the credit for other dependents. So if you're caring for an aging parent or other relative, then you would put that person in here. So let's say Granny Doe. All right. So she's so old that we don't know her real name, or maybe she changed it legally. So in number 14, you're going to state whether or not the child that you're claiming a tax credit for lived with you for more than half a year, or according to the instructions, there are certain exceptions for kidnapped children, children of divorced or separated parents. So if if a child passed away during the year and this home was the child's home for more than half the time, you can still claim the credit. Temporary absences, school, vacation, medical care, going to juvenile detention, those all count as times that they spent with you because they're temporarily away. So we'll say that, yep, we did meet that criteria. Now, for the additional child tax credit, a qualifying child happens to be one that is a relative, son, daughter, stepchild, foster child, brother, sister, brother, stepsister, half brother, half sister, or a descendant. If the child was under age 17 at the end of the tax year, although in 2021 there was a one-time exception for people that were under the age of 18, so 17 and under. Normally it's under 17. They did not provide their own support. They lived with you for more than half the year. They're claimed as a dependent on your return, so they're not claimed as a dependent for someone else's return. They don't file a joint tax return, or if they do, they're only filing a refund for withheld income tax, and they were a U.S. citizen, national, or a resident alien. So those are the criteria for these child tax credits. So we'll say yes. Now, for each person that's claimed as either a qualifying child or other dependents, and now we're including the people in line 13, is that person your dependent? So we're going to say yes under line 16. And for people with adopted children, an adopted child counts. So as long as it was a lawfully legal adoption, right? So if you kidnapped a child and say you adopted him or her, probably not legitimate, and you probably are looking at bigger troubles than getting a tax credit. But if you legally adopted a child, that counts as your child in all circumstances. In line 17, you're stating whether or not that person is a citizen, a national, a resident. Again, you're claiming this credit and you're going through the exact list of criteria for that credit. So again, you're filing this because the IRS disallowed your tax credit the first time around. And a good helpful hint would be to go back through the tax return to see if there was a mistake, because it's a lot easier for you to go back and catch a mistake and then you have confidence that you're filling out the form correctly, as opposed to not seeing or trying to push through something that is going to get rejected. Again, this is a perfect opportunity to correct mistakes. It's also a great opportunity to get caught and slammed pretty hard for committing fraud. So now we're going to go to the American Opportunity Tax Credit. This is kind of the the higher education tax credit. And so a student meets the criteria if they didn't have expenses used to figure an American Opportunity Tax Credit. You can only take it for 4 years. So if you've already claimed the credit for 4 years for the same person, you can't take it anymore. That's 4 years for each student. So you can take the AOTC for 10 years in a row if you have a student that you're raising, you get them through college 4 years, and then you've got another one, and you put that person through 4 years of college, and then you've got a third one right behind, and you can keep claiming the AOTC like that for as long as those children are eligible, but 4 years per person. If the student had not completed the first 4 years before the year that you put on the tax return, so they can't be, in graduate school, and for at least one academic period, the student was enrolled at least half time. So depending on the college, you need to know what half-time enrollment looks like. And as long as the student has not been convicted of any felony for possessing or distributing a controlled substance. So this is the one tax credit that every tax practitioner is kind of forced to memorize, that there's just a mysterious clause at the end of it saying that that anyone who has been convicted of a drug-related felony is permanently ineligible for the American Opportunity Tax Credit. So after reading all the criteria I just outlined, of course, we're going to say that Susan Doe meets the criteria. And then in line B, this is asking whether or not you've claimed either the Hope Scholarship Credit or the American Opportunity Tax Credit for 4 years before. So if you did not, then you're going to be perfectly fine just hitting no. If for some reason you did previously claim it, then you're going to be disallowed. You cannot claim that tax credit. Okay. So now so in part 5, if there's a qualifying child of any other person besides your spouse, if you're filing jointly, right? So let's say you got divorced in the middle of the tax year, but technically, you had an arrangement where you lived together for 3 months, and then you got separated, and during that time there was 50-50 custody during that tax year, and somehow each of you ends up being able to justifiably say that child spent 183 days or more with me. Then you would need to complete part 5 at the qualifying child of more than one person. So only one person can claim the tax credit for the qualifying child. And generally speaking, if the other person is pursuing the same tax credits, then the IRS basically uses a set of tiebreaker rules. So if only one of the so here is the order of the tiebreaker rules. If only one of the persons is the child's parent, the parent gets to treat the child as a qualifying child. So if they're both the parent, then if both parents file a joint tax return and can claim the child as a qualifying child, then the child is treated as a qualifying child of the parents. If they don't file a joint return together, but both parents can claim the child as a qualifying child, then they will treat the child as a qualifying child of the parent where the child spent the most time. So that's the next step of the tiebreaker. If we kind of go through that scenario where they were married, but then they got divorced during the year, they're going to see, which parent actually had the child live with them for longer. So if the child lived with one parent for 200 days and the other one for 185 days, then the tie would go to the 200-day parent. If they ended up having the exact same number of days, then the child will treat the child, or the IRS will treat the child as a qualifying child for the parent with a higher adjusted gross income, AGI. So then they go and take a look at the tax returns, and whoever has the highest adjusted gross income would get the tax credit. Now, if no parent can claim the child as a qualifying child, then between the two people, the child is treated as the qualifying child of the person who had the highest adjusted gross income for the year. If a parent can claim the child, but no parent does claim the child, then the child is a qualifying child of the person who had the highest AGI for the year, but only if that person's AGI is higher than the highest AGI of either parent. So that's a lot of tiebreaker rules, but the IRS kind of goes pretty far down. So all right, so that's now the last part of part 5, sorry, and I'm not exactly sure why there's a decent amount of space, other than I guess they needed to put room for 4 children. If you have more than 4, then you need to attach a list of the additional children. If you lived with a child at more than 1 address, then you would need to attach a list of the addresses. So in line 22, then you're going to answer whether or not any other person lived with that child for more than half the year. And if yes, then you would enter the name and the relationship. So let's just say okay, then again, the IRS will probably come back to ask you to give them additional information so you can verify your eligibility in terms of actually being able to claim the credit. So I think that's all that we have for this video. If you have any questions, please reach out to me. If you want to learn a little bit more in depth, step by step, I've written quite a few articles. I've written an article specifically on IRS Form 8862, as well as the other tax credit forms, the earned income credit, the Schedule EIC, the child tax credit, and the additional child tax credit, as well as the American Opportunity Tax Credit. I'll list all those articles in the comments section so that you can go to them for more reference. If you like our articles, please subscribe to our newsletter. If you like our videos, please subscribe to our YouTube channel. And as always, if you have any questions, please reach out in the comments. Thank you very much.